Welcome to Founders Unplugged, hosted by Greg McCallum. Long-form, honest conversations with founders and entrepreneurs from around the world.
So I'm Callum Woodcock. I'm the founder and CEO of WineFi. WineFi is a fintech platform that makes it very seamless and cost-effective to invest in fine wine through a unique syndicate structure.
You've got that pitch down to a fine art at this point.
I've done it a few times at this point.
Yeah. Good to have you back, man. I think you're the second returning guest from previous seasons now, so that's good. But yeah, man, really good to see you and really exciting to hear everything that's been going on. We were just saying before we click record, when was it? Like just before last year, you joined me and you were just, at that point, you just announced your raise, wasn't it?
Yeah, so I think you were the first interview I ever gave on WineFi. So it's really coming full circle, coming back for a second time. So thank you very much for having me on.
Well, I feel privileged.
It's an honor. It's an honor on our end.
Yeah. Oh, cool, man. I appreciate it. But look, so many interesting things have happened since then. So obviously you had a successful, it was a pre-seed round that when we first spoke, wasn't it? Yep. You had a successful pre-seed round. You launched. Tell me what's happened since we last spoke. I know It's a lot, but try and tell me.
Yeah, absolutely. So you're right. So we closed our pre-seed round in October last year. So we ended up with a number of different angels on our cap table, and then SFC Capital, Founders Capital, and a leading fine wine group called Cohort Holdings, who, if any of your listeners are into wine, own Lay and Wheeler, for example. So they own a series of merchants, warehouse solutions, and generally fine wine adjacent businesses. So they've been a really valuable strategic partner for us. Their CEO joined our board of directors alongside Johnny Keeling, who was formerly Chief Growth Officer at Crowdcube. And yeah, so we started generating revenue. We launched the platform and we had a pretty whirlwind year last year. So we made a number of key hires, and we maintained a pretty impressive growth rate. So we grew by 21% month on month to close out last year with more than 7 figures of revenue. So 7 figures of revenue in our first year. And the really exciting bit from our perspective is, one, there is no doubt that we've achieved product market fit, which was really the kind of key objective for last year. You know, the key hypothesis was that people wanted a vehicle to invest in wine that allowed them to gain low cost exposure, in the same way that people want low cost exposure to the equity markets via an index fund, for example, or a mutual fund more generally. And I think we've undoubtedly proved that. But we are actually showing now that we can outperform the markets. So we're outperforming on every syndicate that we've reported on our benchmarks by between 8 and 18% annualized alpha. So we're putting up some pretty impressive results as well. So a really strong first year, to be honest. I don't think I could have asked for anything more.
And on the subject of Jonathan Keeling as well, I actually spoke to him the other day. He's going to be on the show soon himself.
Is he?
Yeah.
Oh, fantastic.
Yeah.
Well, JK is a legend, and I'm sure he'll have lots of very interesting insights to offer your audience. So you've bagged a good in there, Greg.
Yeah, he's a good guy, and very interested. We spoke about you, and your ears must have been burning because we were very complimentary of you. What you guys are doing. So
that's very kind. Thank you.
Really impressive first year. So what? Well, I mean, did it kind of meet your expectations? Sort of, following the success of the round and the launch, or? I have a feeling it maybe exceeded them slightly.
Yeah, so I think it's always one of those things where I try and manage my own expectations. Historically, I've been either a 10 or a 1 or a 2, and I'm making a more conscious effort to be more between kind of a 4 and a 7. So I remember, and our operations director and I laugh about this now, but I remember thinking, if we've done 500, 600K in revenue by this time next year, I'll be really pleased, because at least that will have shown product market fit, etc. So I think we well exceeded those expectations, which is nice to look back on. But, our whole future is ahead of us. So we're very focused now on really pure growth. So we've got a product that we know works and we're starting to show can outperform the market. The key thing now for us is growth and driving top of funnel. And I think importantly as well, because the vision is larger than just build a really big wine investment business. We really want to be the first company that you think of when it comes to purely investing in wine rather than collecting, which of course many people will do via a merchant, or kind of collecting / investment, which many people also do because they're kind of telling themselves that they might sell some of this wine portfolio that they started as a hobby. And I think in order to do that, we need to be much bigger, clearly, than we are, but we also need to embed ourselves where investors already are. So I think the future of WineFi will be, when you log onto your investment app of choice, there will be a WineFi syndicate listed alongside other alternative assets or other collectibles. And I think that's the vision that I'm very excited to move towards this year, because I think it will introduce this fascinating asset class to a whole new audience and a whole new demographic, and also actually give it a lot more credibility, because it will be for the first time shown on channels that investors are already familiar with. And I think that's really critical for kind of gaining mainstream appeal.
So you're going to be really exploring those sort of those platform partnerships this year then?
Yeah, there's quite a few irons in the fire on that front. So watch this space.
Cool. Exciting. And we bumped into each other as well, very strategically at the Rare Founders demo day.
Yes.
Which was the first one they did, wasn't it? I think. Yeah, it was the first one they did, because I was moderating a panel and you were on it.
Very well emceed by you.
Oh, well, thank you. I appreciate that, considering how poorly I plan these things when I do them. Although I probably shouldn't put that out there, otherwise I'm not going to get booked again. But no. It was a great panel, and you spoke. We were really fortunate in that panel because we had 3 founders, all at different stages. So we had yourself, we had 2 others at all different stages of funding, and it was really interesting because you spoke. All 3 of you spoke really openly and honestly about kind of the highs and lows of raising at that particular stage and running a business at that particular stage and everything about that. Like, what would you say you would add to maybe that now, if you were given the chance to talk about it now? Has much changed in terms of your perception and your experience and etc. since then, or is it broadly the same?
It's a great question. So I think I'm further along the journey than I was. Yeah. So I could probably speak to a few more phases of the kind of entrepreneurial process than I could at the time. I think one thing that has really stuck with me and was echoed by everyone I met that day was really how really building a business is moving from bottleneck to bottleneck and trying to work out what you need to do, what skills you need to learn, who you need to bring in, whatever it might be, when it comes to solving the challenge that you're facing. And I think the challenges that you face as, at its earliest phase, so you want to be a founder, you haven't even come up with an idea, it's clearly around coming up with that concept and then testing it with people, and then trying to get some level of traction to prove that people actually want, the concept that you're building. And I try and look at the journey in those terms. So our bottleneck now, as I alluded to, is growth. We have a platform where we know people want what we've built. So it's now about spreading that message. So it's a challenge that, every business faces, because of course it's a marketing challenge. And I think that, being able to talk about the different bottlenecks that you move through, but really critically, from my perspective, at least on that panel, it was hearing from people that have overcome those bottlenecks. So, the first bottleneck might be going to market and getting, the initial million, et cetera, in revenue. And then clearly it's a very different set of challenges that you face from 1 to 10 and 10 to 100. So I think the further that I get down that path, the more I can kind of talk about the steps that I've been through. And the other really interesting thing that I picked up from the other panelists that day was how, once you've overcome one of those challenges, how insignificant it seems in hindsight. You take it for granted that you've solved it. And that is just a curious thing, because it can feel very daunting. It certainly feels very daunting to me at times, but it's satisfying knowing that other people have gone through almost the exact same journey. The product might be different, but really the channels to market are the same, and the challenges that you face as a founder are the same. And I think that that's just the way that I, if I reflect on what I've kind of, how I've changed since that panel, it would just be, okay, I've overcome a few more bottlenecks. And I think as a result, not that I was ever panicky as a founder, but I think that I understand that those challenges can be solved, as opposed to, nothing seems like luck anymore, which is a uplifting thought. It feels like stuff's not happening by accident.
Right.
It's happening because you're putting those wheels in motion. So maybe that's the way that I've changed. I appreciate that was
No,
a very long answer.
No, I think that's really important to look at things. I think that's a good philosophy to have in life anyway, not to feel like you're out of control, but actually it's far more comforting to recognize that your circumstances and your situations are largely down to you, and that you have a lot more control than you realize. And I think as a founder, that's incredibly powerful. And more importantly, the understanding that you are going to have, more, these bottlenecks are going to come. It's inevitable. And because otherwise, I've talked to many business owners and founders over the years, and there seems to, for some of them, there seems to be this surprise, and it's like, well,
Yeah.
no, this is what you signed up for. That there are and as an organization gets bigger and there are more people involved, there are more and more complications to that. It's no longer just bottlenecks surrounding, going to market or increasing your market share, etc. Then a lot of them actually come down to people, right? It becomes the people sort of management that becomes a bottleneck in of itself too.
Yeah,
Isn't it?
I think when you take business to its natural kind of pinnacle, it's ultimately a people management role. If you, and it looks very similar when you think about the C-suite teams of any large corporate, it looks quite similar. It's all about managing people. I think Alex Hormozy talks about this very well. So I completely agree. It's, I guess that's the ultimate challenge when you reach scale, eh?
Yeah, I mean, how have you found, because you've started obviously to grow the business significantly now. So how have you found that transition to go from being pretty much a solo founder to, I mean, obviously you had a small team around you at the time that we spoke, but now adding more and more people. I mean, that's something of a culture shock there, to a degree, right?
Yeah, I think we've had to get more professional. As we've brought people in. Yeah, I know. So that's actually been a benefit. I think that because we're a small team and because we're relatively young.
Hi, a friendly reminder to share this episode with your network, like, and subscribe. And if you are feeling really supportive, please consider reviewing the show on the podcast platform of your choice. It all really helps support what we do. Thank you. Now back to the show.
And I think also the culture of the business that we're in, partly it's, wine is a fun and exciting space. We're all very passionate about what we're doing. There is an enormous blue ocean, just even when it comes to applying data science to wine as an asset class, because it's never really been done properly before. And it's really surprised me throughout this journey how little has been done, considering how much data actually exists around wine. It's the only collectible asset class where there is kind of real-time valuations provided by third parties based on real trading data. So there's lots to be working with. And so I think everyone is still at that stage where they're very excited about what we're building, which is great. And that naturally creates, quite a tight, cohesive team, despite the fact that we are largely remote. But yeah, you're right. As we've added more people to it, we're just hiring someone at the moment. Their start date's the 10th of February, so I can't tell you who it is yet, but they're joining our data team. He's got a PhD in nuclear physics, which is quite a flex.
And
that's
going to come in handy.
Yeah, exactly. How many wine businesses can say they've got a PhD in nuclear physics on the team?
Yeah.
But I think that, it does slightly change. I've heard, and I'm not sure I can speak to this yet because we're not more than 10 people, and I don't actually know whether we ever will be, but I've heard that the real inflection point comes when you pass that 10-person mark, because you start to hire people that are perhaps more in it because they might be interested in the space, but they're in it for the money, or they want to get experience at an early stage startup rather than really being aligned to the vision. And I think that also starts to happen the further that you are away from, someone that you're employing. So, studies show that your direct manager has the biggest impact on your enjoyment of a role. And I think that's something that we'll be very aware of as we grow. I would say at the moment, we're young enough and scrappy enough that it hasn't really been an issue. It feels like working with a group of friends. And that's a really nice thing because it means that all of us do go above and beyond, because it's not just a job. It's a regular occurrence that I'll get emails or WhatsApps or whatever from the team over a weekend, and it's not seen as a burden. But I assume not, because they're the ones doing it, and it's not like we've asked them to do it. It's more just seen as something that you do in the course of building a company like this. And I think that the the prize is so large in terms of becoming the way that the world invests in wine and almost becoming synonymous with wine as an asset class that I think it's a real motivator for the team. And I hope that that's not me as CEO just interpreting their enthusiasm as something that it isn't, but I do genuinely believe that's the case. But yeah, it'll be interesting to see how that changes as we grow, to your point.
Yeah, but you said you're not really sure if you would grow over 10.
I don't think we need to. So, clearly the data and analytics part of this is really critical. You also need people with a high degree of qualitative expertise around wine. A data model is never going to be fully able to predict wines that are going to outperform. You need to have someone, with decades of experience who knows the trade inside out, who can add kind of a qualitative layer to that. But we're setting up the platform, and it will be probably at the time this podcast is published, entirely self-service, but with the option of booking a call with us should someone want to learn more. And when you think about that, it's really about driving top of funnel, ensuring that the platform converts, ensuring that we have sufficient, I don't know what we're going to call them yet, but customer success type people there to be able to handle inquiries from both existing clients and prospective clients. And we need a bit of an operational team to actually buy and sell the wine. It's very easy when we talk about ourselves being a fintech product to remember that all of our, syndicates are backed by the underlying wines, which are all sitting in a UK government bonded warehouse called Cohort Vaults up in Ipswich. But when you look at that, it's not B2B SaaS. We're not going to need a big sales team or a big customer success team. I'm starting to see it more like a tech-enabled asset manager or a hedge fund, that kind of structure in terms of the number of people on the ground. And when you look at, even some of the largest hedge funds, they have a surprisingly small number of people. We're an AUM business, ultimately. We're a volume business. So I think we can get away with a relatively small team.
Yeah. And I think that's smart. I'm hearing more and more now that organizations are planning to be relatively flat with their personnel growth, over the next coming years. And a large part of that is, some technological advancements that I think are
AI.
I'm not going to. That's playing some part in it, yeah, for sure.
Yeah, sure.
But I also just think, some amount of caution over growing too rapidly from both the sort of company culture perspectives, but also just the cash flow, reasons and everything else that we've heard so many horror stories about.
Fixed costs are scary. They're something that has to be managed very carefully, and obviously salaries are a huge part of that. But I also think that the startup scale-up world has slightly changed. It used to be that indicators of success, especially among founders, actually, as much as I hate to say it, were how much have you raised, and how big's the team, how fast the team growing, and actually neither of those really are like leading indicators anymore. I think the view has shifted as venture capital has become less readily available because of interest rate hikes, etc., to more, can you build a sustainable business? And if the VC taps were turned off at any point for whatever reason, would that business still be sustainable? And I think that's a really interesting paradigm shift that's occurred frustratingly in the time since I've raised money and started a company. That kind of 2015, 16 to 2022 VC bull run seems very distant at this point in time.
Yeah, I don't think it's a bad thing, though.
No.
I still remember my first experience of working with a VC-backed startup, and it boggled my mind that, following the Series A that I was part of, that the number one mandate was spend as much money as possible on hiring new people. And even though we weren't anywhere close to breaking even as a business, and this is me coming out of running businesses and the focus purely being on a Bitster, on profit margins, on you know what I mean. And it was just really mind blowing. It was a real culture shock for me, to go from that sort of very hands on sort of growth, really worrying about the bottom line to that. This was in my sort of early mid 20s. And it really confused me, and I wasn't convinced by it then, and I'm still not convinced by it now.
Yeah.
You know what I mean? As like, this is, and lo and behold, not long after I left, then, things happened in the world of the virus that we won't speak the name of for potential getting the algorithm on YouTube angry, still, which is crazy. But then 90% of the staff were laid off, and it's like, well,
Yeah.
you're not building a company that is. I mean, that was obviously an anomaly, but still, it's a fragile company if you build it on that basis.
Yeah, and I think VCs as well carry a fair share of that blame. And the
Yes.
people I really feel for are the founders that started businesses that still required funding because they had followed that trajectory on the advice or even on the demand of their VCs. Growth at all costs, which is what you're describing. And we saw it last year and the year before. So many businesses just couldn't, either raise down rounds or went out of business because they couldn't keep funding the business because the game had changed, and for whatever reason they weren't able to pivot as quickly as they needed to or as efficiently as you needed to. And in some ways that might be the response, the fault of the founder, and ultimately it is the founder, of course, that has to carry the blame for it, or the team that's running the company that has to take the blame for it. But at the same time, some business models just don't work unless you reach critical mass. Imagine if it's a bad example because they were acquired in their first year, but Instagram, when it was acquired by Facebook, famously had no revenue. And those businesses are clearly designed, like as Snapchat was, to get as big as possible, attract as big an audience as possible, and then turn the taps on. And if you suddenly stop funding a business because of that, because it's not revenue generating, it can't stand on its own 2 feet without venture capital, then you basically ensure the failure of a business that the year before you were backing to continue that growth path. And I think that's quite hard, but then the world's not fair. So
yeah, but you raise a good point. I mean, there are some business models where that approach makes sense. Like you say, Instagram, the value of that business is in the data, it's in the users. Like that makes sense. But there are those where that isn't the case, and they still take the same approach, which just boggles my mind. And I think a lot of that comes down to some bad actors within the VC landscape, which I think are largely dying off, or at least the approach has changed for those individuals, where a lot of it was about bragging rights, it felt like. To either to their LPs or to other VCs, or to get headlines to say, we've got this company that has now grown to this headcount. And it's like, okay, how much money are they making? And that it's almost to distract from that. It's to be like, yes, but they've grown by X amount. They've grown, they've done this, they've entered into this market. They've now launched an office in so-and-so. It was, almost, I felt like it was almost, I don't know, a couple of LPs sat around the dinner table being able to just brag. Do you know what I mean? Like, that's what it felt like a little bit. And I think there was an element of that. But hopefully things are changing for the better. We'll see.
Yeah.
But no, super interesting though. And what I was wanting to ask, so you've got plans for this year for obviously growth, like you mentioned, and these partnerships. And hiring as many nuclear physicists as possible, which is always a smart move.
Nuclear physicists at all costs.
Yeah, of course. That's the way we go. And people complain that the expectations for getting a job these days are too high. Like, no. Just have a nuclear a degree in nuclear physics. It's
how hard is it? How hard is it to get a PhD in nuclear physics? I mean, honestly, kids these days.
I know, right? You got to be prepared to put in the graft, And this is when you tell me it's like, for a job as a receptionist or something. That's our minimum expectation.
Just
as an intern.
I'm going to get so much hate online for this.
No, you'll be fine. Don't worry. What was my point? I was going to ask. So I mean, where do you see things going? Beyond that. I mean, you must have. I know what you're like. Like we've talked before. You have a lot going on up there. So can you reveal much more about where you see things going this year and then beyond?
Yeah, absolutely. So I think we've built a very strong foundation. And when you think what a pre-seed round is for, it's to test the hypothesis and gain that initial traction. I think we've gone well beyond proving the hypothesis and gaining that traction. And we are about to start raising a seed round. That is going to be a pure growth round. We are more or less profitable, but we need to grow faster for the reasons that I mentioned. We are a volume business, and so far, the revenue that we've brought in, a lot of it has kind of been hustled over the line, I suppose. A lot of inefficiencies in the business on the marketing side. The operational side is fantastic. Notably, that's the part of the business that I don't look after. So you can draw the conclusions, whatever conclusions you want from that. But really now the focus is on top of funnel. And I think there's two parts to that. So the first thing is around education. It's really struck me since we, first spoke, how many people saw what we were doing on LinkedIn, signed up to the website, had a phone call with me or a member of the team. And the refrain that we hear over and over again, really from people under the age of like 40, is, oh, I knew you could invest in whiskey. I didn't know you could invest in wine, which is bonkers because wine, one,
If you have a Web3 or AI-focused startup idea, then you need to get in touch with today's sponsor, Dojo. Dojo is a Web3 and AI-focused venture builder based out in London. They're similar to Techstars, Antler, Entrepreneur First, but are also miles different. They take founders with nothing more than an idea and turn them into the next big thing. Dojo is a hothouse for startups through a 12-week intensive development program run 3 times a year with up to 10 companies per cohort. Dojo become the first funder and act as co-founder during their program. Their team includes designers, developers, financial modelers, and partners such as Google Cloud and Vested to provide founders with everything they need to kickstart the business. Since starting in 2022, Dojo has delivered over 10 programs, meaning they've perfected their process, ensuring they cover everything vital for a startup success. You can use the QR code on screen or the link in the description to apply right now for Dojo's next cohort, starting in May 2025, and you'll have an MVP ready to onboard customers by summer. Thank you so much, Dojo, for sponsoring today's episode, and back to it.
Is a much more established asset class, if you can call it an asset class. It has a history going back hundreds of years, but wine investing as we know it now really started in the kind of 70s, 80s. So far, even by that short stretch of time, far more than whiskey. And it's also a much bigger market. So the investable universe, while small compared to traditional asset classes, about 5.5 billion. Whiskey, it's about 1 billion. So there's a huge difference. And then, of course, the bit that I mentioned earlier about how there is, point in time pricing or valuation, much like residential property provided by third parties, without which you can't really call it an asset class, right? So I think a lot is going to be around education. So we are doing, we're going to be running paid ads on socials, so both Meta and LinkedIn. We experimented with that a little bit last year. I got scared because I didn't know what I was doing, so hired an agency run by a good friend who is very, very competent in this space. Obviously the usual things, so paid search, SEO. We're going to put out a lot more content and collateral, even by our standards, to ensure that people are able to compare apples to apples. They really need to be able to compare wine to an equity portfolio, or a commodities portfolio, or a bond portfolio. And I'm very proud of the work that the team achieved last year in putting out. We do quarterly reports, which is kind of like state of the wine markets. The information that we're producing around our syndicates, which is our kind of core product, is getting better and better. And, a real moment for me was to have an asset manager reach out to me, who I knew from my days at JP Morgan, and basically saying, this is on a par with what we'd expect from a professional asset manager, but it's written in language that people actually want to read. And that was a real nice moment because it shows that you can be both. And I think we spend a lot of time as a business feeling quite insecure about treading the line between, being too conversational and too casual, whilst also instilling trust in people that we do know what we're doing. We are able to deliver results, and we are the best choice, if you want to invest in wine, for you to allocate your hard-earned cash to.
Why would you be insecure about that? Is it I think to risk offending either party or talking down to them? Or
I don't think it's about talking down to them, but I think there's a risk that we are naturally quite playful as people. Sounded weirder saying that out loud than I meant it to, but
I know what you mean.
Yeah. And on the one hand, to use like a business example, you have, I'm trying to think of like a really old school asset manager, like a Schroders. And on the other hand, you have like Monzo, going viral because it's commented something hilarious under a LinkedIn post. It's that kind of balance. And we know that we are in a high trust space, especially because wine is an unregulated asset class. So we want the brand to be associated with trust. And our partnership with Cohort, for example, really helps that. The Fine Wine Holdco that I mentioned, the various awards that we've won help that. And ultimately, the main thing that will help that is performance. The proof is in the pudding to a huge degree. But I think that our concern is if we are too conversational, we don't look like a serious asset manager, and therefore we won't be treated by one. It's very easy for people to look at our currently 3K minimum investment and go, okay, yeah, I'll have a dabble. It's another thing for someone to go, okay, I'll stick 100K in because I believe that I'm going to get a capital gains tax exempt ROI on this investment. And I think that's the balance that we really need to strike as a business.
Is that largely down to the fact that you're trying to balance being an attractive proposition for multiple ICPs? Some of which you have maybe been in the game of investing in wine for a long time, but and understand it and maybe have a certain respect or reverence for it, that that kind of language or approach would potentially put off, while also trying to appeal to another ICP which may be a bit younger, a bit new money, and looking to kind of diversify portfolio. Is it that sort of balance that is the issue?
I think that there is a natural conflict there as well, because we look like a fintech business. We position ourselves as a fintech business. We don't want to look like a wine business because, we don't see ourselves as one, a traditional wine merchant or whatever. We need to look different. But at the same time, we need to look trustworthy enough and established enough and serious enough that people will be willing to trust us with, ever larger amounts of capital, percentage of their total portfolios. That's the kind of level that we need to get to. And I think that there is probably a happy medium where you can be conversational and demystify, the asset class, because let's face it, many people aren't familiar with wine and what it can do for them.
In plain English, basically. Yeah,
exactly. But at the same time, not coming across as stuffy or boring, because that doesn't resonate with certainly a younger audience. And when I say younger now, I think millennials have crossed the 40 line. So, it's a balance to strike. And I think one thing that's been quite interesting is, as the level of sophistication in terms of our content and the research that we've been putting out has continued to improve, our age range has slowly increased. So for a long time, we were kind of early 30s was our core demographic, high earners, but younger. And that's crept up on average quite significantly. So I think we're now at 36. But alongside that, the amounts that people are investing has continued to rise. And I think that's a reflection of the fact that we are becoming more established in the market. We're being mentioned at dinner parties and things in a way that we weren't a year ago. Yeah. I think the difficulty with what we're doing, unlike a classic SaaS business, is that if you're a SaaS business, you can offer a free trial. Whereas, other than showing past performance and, giving an indication of what we can do, we can't do that. So we have to produce, regular performance reports so people can see how existing syndicates are performing or have performed. But we get the sense that a lot of people sit on the sidelines for a few weeks or months before making that decision to invest, just so they can kind of understand both the asset class, but actually the business a little bit better. And, that's across the bear. And ultimately a lever that we can pull is, how do you accelerate that time from first hearing about WineFi or first hearing about wine as an asset class to deciding to invest through WineFi because you think they are most likely to outperform the market for you.
And then, like you said, it's optimizing the platform to then make that, once the decision is made, to facilitate that decision being made far easier, right? By automating the onboarding process and so on.
Exactly. It has to be self-service, in my view. Otherwise, we're, another wine company.
Yeah. Yeah. Well, and that makes scaling obviously that much easier. It's really interesting because, it sounds to me like the focus really is on marketing, because what you're essentially talking about here is tone of voice, right? And it's something that, early on, that everyone has some ideas on, but really until you found some element of product market fit and you really know who it is that your product is resonating with, you don't need to spend that much time on obsessing over it. You need to, I'm fairly famous at this point for saying sales before marketing, always, right? There's just no point getting too bogged down in marketing, because it's just, you don't have enough information. You need to know what resonates with people when you sell before you can then go off and use the same language and spruce it up for what works in marketing. And it sounds very much like you guys are really focusing on that, which I think is a really, really smart move, because it's it's like you said, it's blue ocean, right? So it's give it a lot of freedom to a point, but then also I suppose you're going to have to do a lot of research, getting people's responses, getting their feedback, and kind of seeing how they resonate with things.
Yeah, I think you're completely right, and I think that's where last year was so formative because we held many sales calls. To your point, sales before marketing, and ultimately, you have wine as an asset class. It has these characteristics, right? People accept that it can be a good investment for the for the right investor. That's kind of in some ways a given, but in some ways not, because people might not be familiar with wine. So you need to educate them on that piece. And then the second piece is like, okay, well, why WineFi? And I actually think that our proposition is very strong because you can gain diversified exposure to an expertly curated portfolio of wine at a fraction of the cost of owning that same portfolio outright. And the downside to that is you can't unilaterally take the wines out and drink them, because you're co-invested alongside other investors. And it's about getting that message across. And for some people, clearly it really resonates. So we wouldn't have grown as fast as we have. For other people, they're going, well, why would I invest in wine if I couldn't drink it? And they're not really our target demographic. So it's not as simple as just being like, oh, it's people that are into wine. It's more like people that are into alternative assets. And it's been quite interesting having those conversations. And, in the early days, we had a number of customers that had private portfolios with us. And we're actually really moving away from that, apart from investors that want to invest higher amounts, because, that's something that you can go to another business for. You can't go to another business to gain cost-effective exposure via a syndicate. And that, I think, is the niche that we have to absolutely dominate.
Have you found that those who tend to be interested in your proposition have some things in common, such as they tend to invest in other assets quite frequently, like, I don't know, like gold or crypto, or something? Is there some commonalities that sort of crop up time and time again?
Yeah, definitely. I think they have to be interested in investing, first and foremost. No one comes to wine, or at least they shouldn't, as their first investment, right? Most of them will have at least an equity portfolio. There's plenty that will only have exposure to, an S&P 500 tracker via an ISA or something. But they need to be interested in investing because ultimately they're expecting an ROI on it. And, we've done, I would say, quite a good job trying to stay at arm's length from the get rich quick crypto crowd. But if you're into crypto, chances are you are into alternative assets. So there's certainly an overlap there. I think it also just interests people. It's the fun part of their portfolio. It's something that you can talk about with your mates or at a dinner party in a way that you can't talk about that S&P 500 tracker fund that you're keeping in an ISA. And we use that a lot. And I think it's, I find it pretty mind-blowing whenever I visit Coterie Vaults, so our bonded warehouse, and seeing these cases of, Domaine della Romani Conti that cost 14K a bottle or whatever, under the name of a syndicate in the storage facility. And obviously we produce lists of the holdings for syndicate members. And, it is a bit of a flex saying, oh, I'm invested in, this portfolio that's worth on aggregate 400K or whatever.
I would say a bigger flex than having a nuclear physics PhD.
I think so. I think so too. But the great thing with WineFi is you can actually have both.
Right.
For less than the cost of a PhD in nuclear physics, you can gain exposure to a portfolio of wine.
Man of the hour at that dinner party for sure. Yeah. Well, yeah. I mean, it's it's an interesting point in time, isn't it? I mean, I don't know how founders do it really, because there's so many data points now. How do you sort of manage to focus on the what you believe at least to be the right things at the right time? Because like even in this subject of marketing, finding your voice, it's potentially so easy to get drawn into so many different avenues of, like we're saying about the data points of, okay, what are the lookalikes, what are the things that they're interested in, and then there's a whole rabbit hole there, and then there's the visual style, do we need to rebrand, and then now you're looking at a Series A, and then the growth of the team, the dynamic of the team. I mean, how do you at any given moment in time sit down and go, okay, this is 100% what I need to be focusing on right at this point in time?
Yeah, for sure. So I think the first thing is the North Star has to be revenue. So if, we're growing month on month, then we are doing fine. The bottleneck, to use that phrase again, is we've noticed naturally, because the platform wasn't set up to facilitate scale, that clearly it's subject to the law of diminishing returns. What looks great in month 5 isn't what looks great in month 12, because obviously every month you need to show significant month-on-month revenue growth. And I think in Q4 last year, we kind of went, right, okay, we've got product market fit. It's now time to shift the business into scaling mode. And I think we've done that relatively seamlessly because we'd planned around it. So we'd gone, okay, we're going to hustle these deals over the line, speak to as many customers as we can until we've got product market fit. And once we've got product market fit, assuming that performance is good, and thankfully it is, because it means our models are working properly and our investment committee are working properly, then it's about filling that funnel. And there is a bit of a trade-off because we're such a small team.
If you are enjoying this episode and want to support the show, please like, subscribe with notifications turned on, and let us know your thoughts and opinions in the comments below. This lets YouTube know we are doing something right. Back to the show.
You have to set up the architecture and the infrastructure yourself in order to facilitate that. So, whenever we've got a map of our funnel, we've got top of funnel, middle of funnel, bottom of funnel. And, it's basically introducing now new top of funnel channels that we haven't used before. And obviously that comes with a time overhead, managing whether or not they're agencies, you still have to manage them. And then it's about optimizing ultimately the platform, the site, and the funnel to ensure that as many people as possible flow through. So we know that at the moment, for example, we have a 16% conversion rate between someone that views the documents for one of our syndicates, so looks at the one pager or looks at the presentation or whatever it might be, and those that end up investing. The interesting thing, and we haven't got data on it yet, but hopefully when we do this podcast again in a year's time, I'll be able to tell you, is whether or not we can keep that conversion rate as top of funnel becomes broader. Because at the moment, most people are finding us through LinkedIn. Our hunch, and again, we don't have any data to prove this, is that they've been following us on LinkedIn for a while. So we've kind of warmed them up. They've been exposed to WineFi content. They may even feel like they know us to some degree. They might have interacted with us somehow. And that's going to be very different from when someone's coming in completely blind in some ways. They've clicked on an ad because they go, oh, cool, I didn't know you can invest in wine, or, oh yeah, I've been thinking about investing in wine. And then they go through the WineFi funnel. So it'll be interesting to see how that works. And really, I'm happy to spend the next, certainly to the end of quarter, experimenting with those channels in order to kind of see which ones are working. And, you can really break it down, as you know. So, if people are clicking on an ad but not converting, it suggests that the landing page is the issue versus those that aren't clicking on an ad at all. So you can start really making decisions based on data in a way that we haven't been able to make decisions based on data because we've been so focused on one number, which is revenue. And obviously revenue is a lagging indicator. What we're now doing is focusing on the kind of lead indicators. And that's exciting. And it's a new challenge for me. I've never done it before. I've come from a B2B sales background. I'm comfortable with sales. I'm comfortable with speaking to people. In that sense, I've never done any marketing, particularly not B2C marketing like we're currently doing, performance marketing. And I think that's that's where we're shifting our focus. And I've got a board meeting on Wednesday this week. And, my main message to the board will be like, we are where we said we would be. And we're at this phase of this plan that we were executing on last year. We're going to take time now to experiment it and work out what allows us to scale. Because otherwise, I think based on what we've done so far, we could build a fine business, as in, it's a good business. It's just about profitable, and we could carry on that path, for an indefinite period of time. What I want to do is build a business where it is the first port of call in anyone's minds when they think about investing as wine as an asset class, in the same way that, Vanguard is the first fund house that you think of when you think about investing in index funds, or in the collectible space, Masterworks perhaps is for art for most people. And in order to do that, you have to understand your unit economics and you have to understand the channels that are yielding those results. And so, one of the reasons we're fundraising is to allow us to do that. And that's how I think you build a truly venture scale business in this space. Otherwise, it's a relatively low margin space compared to SaaS. You end up just doing what you're doing, and that's not going to scale as effectively as nailing the kind of 2 or 3 channels that are really going to drive top of funnel, and ultimately everything else flows from that.
Yeah, absolutely. How do you approach sort of looking at a set of tasks or a challenge that you don't feel like you have an enormous amount of proficiency in? So, like, for example, you just said about marketing, right? You're not, you previously you really were in B2B SaaS sales, and that was your expertise, I guess. So now that you're staring down the barrel of this year really being about performance marketing and really getting quite granular on it, are you going to be approaching that by sitting down, lots of YouTube, or bringing people in, or a bit of both? Like how, or generally, more broadly, not just that specific task, but how do you generally tackle that when you have it, when you're given a situation where you're like, okay, I need to learn about this?
Yeah, so I actually have had to adapt a lot to this. I found that I would procrastinate around topics that I wasn't comfortable with, especially if I got confused on them. I'd get to a certain point and gone, how do you do this? Oh, I'll do it later. I am trying to get better at that. The thing that I found that works for me, and this is probably oversharing in this podcast, but we call we call our quarterly objectives rocks. So we follow the traction framework, if anyone knows that book by Gino Wickman. And I found that, so obviously you have an objective, but rather than just having like a series of sub goals, I've actually found anytime I take a step towards a rock, I write down the action that I've taken, almost like, how you have a to-do list and you cross things off. This is like a to-do list that I'm doing in real time. And some of the things I've written on there before because I knew I had to do them, and other times it's just to show progress. And I get a little dopamine hit, and it shows your progress, right? Even if it's something as simple as I've done this marketing course, or I've spoken to this person about this conversation, or I've watched this YouTube video. Now, all of those are, well, apart from speaking to someone, all of those are kind of like passive ways of acting. But, sorry, I'm going to cough. But they do kind of give you that sense of progress. So I'm leaning into it in quite a big way. And just to give, your listeners an idea of how naive I was until last week on this space, I only found out what UTM tracking was, which is where you have a link and you can click on the link and it shows you where that prospect is coming from. I only found out about that last week. So, I am very green. And, as a result, I have hired agencies that know what we're doing, what they're doing, and who so far have been absolutely brilliant. And the CEO I mentioned, the CEO of one of those agencies is a good friend, and has basically said, look, I'll be your kind of fractional behind the scenes CMO in terms of educating you around the stuff that you need to know. And I trust him enough that that's not a ploy to get us to up our spend with them or whatever. But that's going to be really valuable. I think I learned from talking to people and being shown how to do something, first of all. But then it's all about breaking it down for me. And I would say, like, historically, I've been really bad at that. And, I wanted to be a founder from the age of 22 when I left university. And it took me 7 years to actually go full time on a business. And that was largely, I think, not really procrastination, but procrastination in all but name. So it was like reading around a subject rather than actually getting stuck in. So I read like every sales book under the sun. I read like every, iconic book on being an entrepreneur, Rich Dad, Poor Dad, 4-Hour Work Week, The Hard Thing About Hard Things, all of those classics, which I'm sure you've got on your shelf behind you.
There's a few there, yeah.
Yeah, but it's only by actually doing that I find I'm able to learn and actually able to retain information, because otherwise it just sounds.
I think that's the same for most people. I mean, more than just because I think that's just a better way to learn things because they stick with you, but also because there's so much that, in terms of a skill set that you need. It's so broad, it's so wide that there's no way that you know what skill set you're going to need and when ahead of time. To sit down and be like, okay, this is everything you need to know. I mean, I know there is some courses for entrepreneurs that are incredibly good at the way they go about this, but for the most part, I think it's just overwhelming. Like if you just sit down to a founder, as let's say a seasoned founder that's been the CEO of their company for say 10 years, and that person says, right, here is everything you're going to need to know. Here's the entire skill set laid out. We're going to have a 10-hour conversation, and then by the end of it, there's no way that person's walking away with any semblance of confidence that they suddenly know what they're doing. It's just overwhelming. But to tackle it as you, like you say, the bottlenecks, to attack them as they come to you, and go, right, okay, I now need to go and learn about this thing because this is important. It's now priority, or it will be priority. Even better if you can do it with a little bit of foresight so you're not caught off guard. Then I think that's a very sensible way to approach it.
Definitely. And I think there's a phrase, it might have been Mark Andreessen, but I can't really remember. But someone compares to, reading about entrepreneurship is like learning to swim by reading a book about it. You only really learn by doing. And I think that can be applied to pretty much any walk of life.
Pretty much.
And then the only other thing that I've learned is where you're weak and the gap between what you're able to do and what you need to be able to do is so broad that you're not going to be able to bridge it through, a few weeks hard work is higher. So our operations director, Ollie, who I first met years ago, I hired him as an intern at a previous company. He's amazing on the finance side, did economics at Bristol and then classic A levels, further maths, economics, all the boring ones. And he's incredible at that side of the business. And it doesn't make sense for me to try and get to that level because he's so...
You understand what you need to as the CEO of the company, right? It's not like you totally right out to it. But there's no point getting too granular on it if there's someone else who's going to be able to do it far more competently. Yeah, absolutely.
Definitely. And there's I mentioned Rich Dad, Poor Dad earlier, which was like the first book I read when I was like 17 that made me want to be a founder. Robert Kiyosaki is the author. And he talks about, the fundamental skills are either learning to sell, which is why I went into sales, or learning to build, basically meaning being a developer. And how actually it's much better to double down. I think Y Combinator talk about this as well, but like it's much better to double down on that skill set that you already have. Because, even if I was to do a coding course, and maybe this is changing with kind of natural language, AI generated platforms that allow anyone to code, but ultimately I would end up as like an average developer or a below average developer, when actually it's much better to double down on what you're good at and just be like, okay, I'm going to be above average or ideally excellent at that skill set. And I think that's something that's like a lot of, especially younger founders or like entrepreneurs, people that aren't yet founders, kind of think that they have to do everything by themselves. And I thought that for a long time as well. And it's just so not true. It doesn't make sense because it's not like you do that in any other walk of life. If you wanted to learn how to play the violin, you get violin lessons and then you practice the violin. Why is building a business? I think there's such like a myth of, these people that pull themselves up by their own bootstraps. And sure, that might be true to a degree, but ultimately someone must have helped them on the way, or they would never have achieved what they wanted to achieve. And that person might be as little as, an agency that they're paying to run, some part of the business. And I think that's important not to lose sight of. There are subject matter expertise or subject matter experts rather in every walk of life. Use them, especially for a venture-backed business. I don't think you've got any excuse because you've got cash from the beginning.
Yeah. And I think, personally, I think if you're not technical and you don't have a sales background and you want to be a founder, I would say that, and obviously I'm biased here, but it's far easier to learn how to sell than it is to learn how to code. So if you really need to go into anything and upskill in it, and you're not prepared, maybe you're slightly older or whatever, you just don't have what you believe to have the capacity to learn how to code and to go through that route, then I would say, because for me, and we've talked about this before, selling isn't some mysterious art form. Like it's actually just, the skill of communication. And I think if you're a good enough communicator, then it's actually fairly easy to pick up compared to something like coding, which I think is far deeper a skill, really. So I tend to tell founders, like, just concentrate on being a founder-led, a sales-led founder, and you'll be fine.
Yeah. Greg, really quickly,
Yes.
Can I move rooms because my fiance is about to kick me out because she's going on a call?
Funny you say that, but we've approached the end of part one. So yeah, absolutely.
Fantastic.
We're going to take a break. So for those listening and watching, come back for part two in a couple of days. We'll be back and we're going to talk about lots more stuff. So yeah, I'll let you go and you can change room and make sure you're subscribed and all that, everyone. We'll be back for part two in a couple of days.
Thank you for listening and or watching. Subscribe with notifications turned on to get notified when part 2 comes out. While you wait, please join in the conversation in the comments below.